Welcome back to the course Introduction to Commercial Banking and FinTech, and in this particular course we are discussing about the need for the commercial banking and how commercial banking regulations have shaped the global economy and global banking system. India adopted the Basel I norms in 1990s, and then post that we saw that the Indian banking sector outlook improved. There were less failures. Central bank also had a very easy time to monitor the banking sector, and it did not kill the liquidity. So one of the important jobs of the commercial bank is to create liquidity, enough liquidity in the economy, and we saw that post 1991, which is also the era of economic reforms that India had to undertake in the guide of structural adjustment program of the IMF. So at that time we also saw the banking sector coming up in a reformed way. We also rationalized the fractional reserves system, mostly CRR and SLR. Narsimham committee did a very good job at that time for suggesting that how Indian banking sector should be functioning with the global vis-a-vis global standards and how it can create a good global impact. And post that we have seen that Indian banks remained healthy, though the regulation allowed only 8% of capital adequacy ratio, but they maintained beyond 10 to 12%, and this is what we found. Now there were also the loopholes in the Basel I. Basel I, the measure was that though it created the harmonized global capital framework for the banking sector, and it also had created less market oriented system for the tax, which were having not that much of the competitiveness. So it also created that simple and easy to implement. It was also about that weaknesses. So crude risk buckets, right? So this is what we mentioned, that though the capital adequacy ratio was 8%, but it also still allowed banks to arbitrage, and they were able to do that, and this created further credit risk and ignored operational risk, that how banks have to maintain 8% even though they have to take into account some other risk weighted assets that we saw. The banks started manipulating that and showing the 8%, encouraged securitization and balance sheet arbitrage. So this was also one of the reasons that why we saw that the capital did not change, but they were able to improve the CAR. So this also created a channel. And off balance sheet exposures were not well treated in the Basel I, and this created further way to target, and this led to the introduction of Basel II in 2004, and this created a whole lot of scenario. So let's get into tier 1 and tier 2 capital, Basel capital in one picture that I have given the title. So regulatory capital is always, you have to remember that it is the loss absorbing buffer used in capital ratio. So loss absorbing buffer is the key term that we have to see. So we have to, whatever loss that the bank is expected to make, it has to be. So there are two the chronologies, or you can say common terms that we nomenclature that we attach. Tier 1 is the going concern capital, which means that it is ongoing, right? Tier 2, which means that already it has gone. So gone concern capital, which means that absorbed losses while bank remains operating, right? Absorbs losses mainly in resolution liquidation, and this is the bankruptcy process that we see. Corporate insolvency, we also call it as CIRP. In India under IBC, this law is applicable, Insolvency and Bankruptcy Code. So tier 1 seems to be a stage where the damage can be stopped. Tier 2, you don't have any option, you will be tried under bankruptcy law. What is the common equity term that we often say? So tier 1 that we often say, it is nothing but CET upon RWA, and CAR is also we are saying. So tier 1 ratio, so common equity tier 1, it is the RWA, right? And tier 1 ratio that here we have tier 1 capital upon RWA, and CAR we know that total capital, so it includes both tier 1 and tier 2 upon RWA. And Basel III will discuss, I think it has been added after that. So common equity, what do we include in tier 1 capital, right? So in tier 1, here we have the common equity tier 1, right, plus additional tier 1 is the term that we have often seen or used by the banks and bank professionals. So tier 1 is the common equity tier 1. So tier 1, you can say here it is the common shares upon the paid up equity. So this is what we had solved, and this is what we often get with the retained earnings, this we call it, right. So retained earning, disclosed reserves, that you have profit and you have already acknowledged. Then here we have the regulatory I would say deductions. Here you have goodwill and certain the allowances that you have, tax related allowances. So this is what deferred tax allowance we say. So deferred tax allowances which you have, so this you can go for it. So common shares, which is the paid up equity, which means that what the company has in terms of value, plus retained earnings. So this is what tier 1 capital shows, plus disclosed reserves, minus you have regulatory deduction that you have. So goodwill, if the bank, you can calculate the goodwill based on the subjective classification that we have, plus the tax deferment that you have. Additional tiers, perpetual instruments. For example, you have some instruments which are having continuous infinite maturity. So this is what here we have. Mostly you can say bonds of different types rate with the central bank. So in this case, discretionary coupons, here it implies that we are attaching with some of the short term bills that here we have. Less observancy by write downs and any kind of trigger that you have breached. So this is what. So tier is the tier 1 capital is, you can say, it gives you the some kind of absorption, write down and conversion related adjustment also in additional tier 1. So CET, you can say it is having a good sense of how the banking sector is doing. So it is also about the performance. And additional tier is what kind of asset it has. So this is what here we have. So which means that tier 1, we can see the risk side of, if you have disclosed reserves getting lower, if we have retained earnings getting lower, bank has not declared dividend, but it has gone for retained earnings. So that you can also see. So common tier 1, common equity tier 1 shows the overall performance of the bank in the, you can say, in a stock market when it is listed, and this is what it implies here. So it is a going concern kind of setup. Now here, if you include that, what is that? So paid up common equity, which is related with what the shareholders equity are there, then retained earnings, other disclosed reserves and regulatory deductions like goodwill and deferred tax allowances that we saw, right, intangible deferred tax assets that here we have. So this is what we have. Investment in financial subsidiaries that you have. So this is what we also say in terms of the deduction, which means that if SBI is having investment in the MCXSX, so this can be also the, it can be called as regulatory deductions, right. So equity, if it is 600, return earnings are 200 and goodwill 50. So overall your common equity here it is going to be 750. And why we often say that the CET1, common equity tier 1 capital, is the strongest capital for the bank, because it is having permanent, because it is listed on the stock exchange and it will have the perpetual like dividend and retained earnings and those integration, no mandatory payout. Dividends are optional in some cases and you don't have to, in India it is not mandatory for all the banks to declare fully available to absorb losses. You can, so disclosed income that here you have disclosed what we had mentioned, reserves, you can use that anytime whenever you want, right. And first in loss waterfall, if you have like any kind of loss, so if credit losses are rupees 400 crore, a CET1 new will be around 750 minus 400, so 350. So bank will remain solvent and it will not be insolvent, right. So this is what here. So CET1 directly protects depositors and systemic stability is there. So CET1 is very important, and I am just giving you again the one more definition, that in the case of capital ratio that we mentioned, so CET ratio common equity tier 1, which is the going concern capital, it is nothing but CET1 upon the risk weighted assets, and tier 1 ratio will be nothing but what we have already got from the Basel 1, tier 1 plus tier 2 capital. And in this case in CAR, when we calculate, we take about the total capital. Tier 2, why? It is the gone concern, right. So the bank has already gone for bankruptcy. Tier 1 becomes important even in CAR, and tier 1 why we are discussing, because of this reason, that it includes the shareholders equity or common shares that here we have. So if the price goes up, the overall common equity tier will go up. If price of the stock comes down, then it will be also coming down. Retained earnings, if the price of the stock is going high, then you are and whatever profit that you have from the different sources, income plus non-income, or you can say net income that we calculated in the balance sheet, net interest income plus you have the non-interest income. So that you can also see here. Disclosure, retained earnings higher, in the sense that you are not declaring dividend, but you have retained that earning. Here you have the, in terms of disclosure reserves, so which means that you have already acknowledged in the balance sheet that this much you have the crores of rupees of profit. So that's why common tier 1. Additional, you have any type of other instrument that you have invested in, and it is having perpetuity kind of earnings, right? So this is what we get. Now, in additional tier 1 capital, one more thing that we have to note it down, that here it talks about the hybrid capital instrument designed to absorb losses while the bank is still operating. So this is what we have, and loss absorption, what we are doing here in terms of, so here we have the perpetual no fixed maturity kind of instrument that here we have, discretionary coupon payment that you get, plus write downs and convergent equity, all those things are a part of. So if the CET ratio falls below threshold, for example 5.5%, 81 may be written down or converted. So which means that this 81 will be absorbed in CET. So this is what it implies here. Tier 2 capital. Tier 2 capital is the gone concern buffer, which is also about the capital that absorbs losses primarily in resolutions. Components are like subordinated debt, limited general loan loss reserves, which is like very special kind of, any kind of eligibility of such type can be here. So for example, subordinated debt is 500 crore, eligible provisions that you can do in the balance sheet is 100 crore. So tier 2 is going to be 600 crore. So tier 2 is like gone concern buffer, which means that it includes your subordinated debt and then limited general. So it has the fixed coupon obligations and has maturity. So let's understand what is subordinated debt. I have added 1 or 2 slides. So subordinated debt is a long term debt that ranks below senior creditors and deposits in case of liquidation. For example, first it will be equity, then here we have the AT1, then tier 2 subordinated debt, then senior debt, and then it will go to the depositors. So this is what we often get. So here it is also about the, so key characteristics of the subordinated debt is that it is having the unsecured obligations paid after whenever there is a claim. It has the fixed maturity and it also goes by. So in Basel III, the tier 2 has got more recognition because this was observed during 2007-8 financial crisis, and it was found that majority of the banks were not able to meet, and this was the reason that why the banking sector was. So Basel III has more focus on tier 2 capital, and this is what it was. So why minimum maturity retirement exists? So it is mentioned that subordinated debt it has to be repaid. It creates also the rollover risk. Some people may not be surrendering. It also weakens the loss absorption capacity, and this is what we often say. So Basel III, I think this will be discussing again, but for the sake of simplicity, because tier 2 is directly linked with the Basel II, so we have mentioned that here, right? So this is what it implies. Now here we have the amortization rule, which is also like how we can go. So recognition of the subordinated debt comes down linearly as the maturity reaches. So here if you have the, if bank issues rupees 500 crore subordinated bond, right, original maturity is 10 years, right, at 5 years of remaining, so it is like 100 years eligible, 3 years remaining, so here you have 300 crore, at 1 year remaining you have 100 crore of payment, right. So this becomes like important rule, and you can think about how it is burdening the bank. So as it has more, so if it is like 1 year remaining to maturity, then you have 100 crore and so on. As we go on, we can see that the burden is also going up, and this is what it implies. Now, if I have to understand from both common equity tier 1 and tier 2 capital, how we can understand. So, suppose we have a bank which has the common equity tier 1 of 750 crore, additional tier 1 here we have 250 crore, and tier 2 here we have 500 crore. So, tier 1 is going to be how much? It's 750 plus 200, so 1000 crore. Total capital is tier 1 plus tier 2, so 1000 plus 500, so it is 1500. If RWA is 10,000, so how much is the CAR? So, CAR will be 1500 upon 10,000. So, this will be a 15%. If I have to calculate the common equity ratio, so common equity ratio upon RWA is 750 upon 10,000. So, common equity, you can see that it is having 7.5% share of total risk free risk weighted assets, but CAR, both CET, both tier 1 capital and tier 2 capital, if we are summing up both, then it comes out to be 15%. So, which means that if you have the high CAR with CET weak, right, so this may create a trouble for the bank, and this is where we have to understand that why the tier 1 capital and tier 2 capital is important. So, tier 1 here is coming out to be more than 50% total capital, you can see. So, more than 50% here you have the tier 1 capital, right, and it means that you still have the in this case you have almost like more than 50% of tier 1, which means that concern it is not like going concern kind of setup, but had it been the tier 2 more like 1000 crore, then it would have been like surely bank is fragile and it will have the negative impact. So, common equity tier becomes really important, and how it becomes important, that if bank will do well, its equity market performance will be better, and then common equity tier 1 capital will be better, right. And if the profitability is going better, then of course it will be reflected with that same. Now, tier 2 capital is definition and loss absorption tool. So, here we have tier 2 subordinated debt with minimum maturity, so loss absorbing after tier 1, limited recognition of general provision. So, this is what loan loss reserves that we have. Why we have the tier 2 existence? Because it provides the additional buffer, right, and it also, so subordinated debt create a good kind of options for the creditor and to go for resolutions, but it has the lower quality, more sensitivity, and it also talks about banks fragility, and that's why it is having the more gone concern kind of scenario, right. So, this is what. So, in majority of the regulator cases, we see that regulator restrict the share of tier 2 in total capital to preserve the capital quality, because if tier 2 is higher, as I mentioned in this case, right, in this case tier 1 is more than, out of 1500, tier 1 is 1000, right. So, which means that more than 60%, which also shows that bank is relatively safer, not that fragile, but had it been the opposite case, that 1000 is the tier 2, then bank certainly has gone for creating excess burden, and this creates the trouble for the bank later, right. So, this is what we imply, and that is why tier 2 is very, very important, right. If you see in the global setup how it looks like, so how the loss waterfall that we get. So, first is the CET, common equity tier 1, equity reserves, then here we have the AT1, additional tier. So, which means that here we have the perpetual, contingent, those will be sorted out. Then after that, here we have subordinated debt, then here we have the provisions related kind of debt. So, this is what tier 2. Tier 2 becomes more compliance oriented, because then if you are going more of the provision, then you know that in balance sheet it will be impacting negatively, and again your tier 1 will be impacted, because then you have the disclosed profit, you have the retained earnings will be lower, because this will have the negative impact on the balance sheet. As a result, the investors will be also worried, and this creates trouble. So, senior debt concept comes in this, and then finally it comes to depositors and others. So CET primarily it has been designed to absorb losses first, and AT1 and Tier 2 add buffers in this direction. So this is what we imply here. So if you see the comparison, that how the comparison looks like, so as you can see that CET versus AT1 and Tier 2 comparison, if you see, so capital quality, if you go capital quality wise, common equity Tier 1 has the highest quality. Then if you go by the additional Tier 1, it is hybrid because it includes perpetual and the other disclosures and bonds and other coupons, and it has the lower supplementary in the Tier 2. Loss absorption quality, you can see it is the first absorption, first loss will be absorbed through the Tier 1 capital. After CET1 write down and perpetual, it will go the additional tier. In loss absorption in case of Tier 2, it goes only by resolution, which means that you have to go for liquidity and some fixed maturity minimum years that you have to do, right. So this is what here we have. Coupon dividend, discretionary dividends that you have, right, fully discretionary coupons that you get, and usually you have the fixed coupon. A regulatory role, here we have the core going concern of capital. So this is what here we have. Additional going concern buffer is this, and this is what is the going concern buffer. Now here we have the equity shares, here we get the equity shares reserves, and this is what we often find. And AT1 in this case, here we have the perpetual bonds, and it also gets into subordinated debt. So overall what comes out that CET is the winner. This has to be higher for banks to remain healthy. Tier 2 mostly you can say it is talking about resolution, and it has the lower supplementary and has the lower resolution, and fixed maturity is much lower, and it also has the fixed coupons and others. So this is what we get in this. So regulatory priority, if you think about regulatory priority wise, this is what here we have the capital quality concern that we get. Now let's think about the Indian setup, what we call it. So RBI has already put the capital adequacy ratio above the Basel baseline, which was the 8% earlier, but we found that majority of the Indian banks had the share of, you can say, around 10 to 12% they maintained, and it was greater than that. Public sector banks faced the common equity Tier 1 pressure, and they mostly incurred because they experienced high non-performing assets, and they were experiencing high, and as a result they had to maintain. We saw this happening during 2007-8 global financial crisis, and post that when the global economy recovered, at that time majority of the companies were still lagging behind, and they requested the banks. So a lot of banks went for evergreening of accounts. So NPA cycle created that kind of, and then some kind of recapitalization efforts were also made post that, and this created trouble. AT1 issuance mostly has been used to raise Tier 1 capital, mostly the perpetual instruments with loss absorption, we can say. But if you have to decide that which type of banks are good or bad, so you can say that the strong headline CAR and a good quality CET1, common equity Tier 1, it decides the good faith, and it brings a lot of confidence in the banking system, and it also helps you understand the overall quality better for the banking sector. And overall what comes out that the banking sector created a whole lot of scenario for this. Coming back to what we have, so maybe I will cover this particular part, risk weighted asset, in the next session. But one of the good learnings about this whole setup is that how common Tier 1, which includes most of the disclosures related and income related stuff, becomes the hallmark of the banking sector success. In common equity Tier 2, we saw in comparison that it is mostly linked with resolution, and that's why when we discuss the Basel 3, this will come again, gone concern, because additional going concern buffer that here you have. Subordinated debt is another concern, fixed maturity minimum years that you have to go. Then it also becomes the supplementary kind of, it has the lower weightage. So in a resolution, if I am the bank, and if I am operating in the commercial banking space, and I have to think about my health, so I have to go for first CET1 in terms of capital quality, this has to be higher with retained earnings and disclosures and other regulatory deductions that we make, regulatory deductions we can say. Second, here we have that this will have no any maturity kind of issue. Second, here we have all the dividends and all decided by the bank. A regulatory role that it is having the going concern, so it is not the gone concern, and this creates the whole lot of a good impact. Another good thing to note is that you can see that in the waterfall kind of scenario, the common equity comes on top, then followed by AT1, then tier, then subordinate, then the depositors insured priority, right. So, this is what we get. And in terms of tier 2, I have already mentioned that in tier 2 here you have the subordinated debt kind of setup. So, with this I hope you are able to understand that why in Basel II norms capital quality matters, and it mattered, and majority of the banks were able to focus on the common equity tier. And we also can see that why tier 2 became, so common equity tier 1 was the main primary contribution of the Basel II if you ask. Basel III created more focus on the CET2 because during 2008 financial crisis, majority of the banks were looking for recapitalization. So, as a result, we saw that in Basel III the focus has been on tier 2. So, with this I am stopping it here. I hope you are enjoying this particular course and you are improving your learning on the commercial banking. You can always write to us or for any doubt or any kind of question that you have. With this I am stopping it here. Thank you so much. I appreciate your attention.